Hey, what's up, everybody? It's Mickey here, and I just wanted to do a quick class on, a couple of the reasons that institutions and size traders use options, right? And then I want to give a couple of quick examples of how I use dialect to navigate through the market data with these and to find what I'm looking for to identify what institutions are getting into what options. Now, a quick spill about dialect is a very powerful trading app that filters and files a lot of data from the CBOE and makes it very visible to see. It's a really great platform that I'll probably use the rest of my life. Now we know that we are in a asset managed based market. It isn't a commission based market anymore. The institutions, they make a percentage to manage shares. Why would they even consider selling their shares when they get paid to hold? Why sell when you get a 2% annual profit to hold and look good doing so? Look at the top institutional holders on the screen for Apple. Vanguard holds 1 billion shares, and 2% of that is 20 million a year just to hold it. Now look at the shares outstanding. There are 16 billion shares of Apple out there. Now look at the average volume of shares traded in the last 3 months. It's 88 million. That is 0.5% of shares available. So think supply and demand. If Vanguard even wanted to sell, they couldn't due to lack of liquidity. Okay, a couple of reasons institutions are using options, right? One, to hedge. Like the whole purpose of options was to allow these institutions to buy puts and put in their shares at a delta neutral position. Delta neutral hedging is a very useful and powerful method to repair losing positions. So they do this by buying enough at the money or near the money to offset the positive delta of their existing shares, right? So by executing this adjustment, if the stock should continue to fall, they will profit on the put options that they have purchased, and that offsets the losses if the stock continues to move lower. And this will have a whole video of itself where I teach you how to do that. So second reason is to create additional income from shares they already own. Um, so think of it like this: if you buy a house and then you don't live in that house, you move away for work or whatever, are you going to just let that house sit there, or are you going to sell the house? Well, let's say you're not in the market where you can sell the house. Like, so you rent the house out for additional income. You can do the same thing with stocks. If you have 100 shares in that stock, it gives you the ability to sell, you know, puts and collect the premium. So let's say we think Apple is going to like announce that they are creating an electronic vehicle like the iCar, and we know that we already own 100 shares of it, and we know that this news is going to make Apple skyrocket for the next couple months until the next EV King comes out here, right? We know that Apple's not going to hit a certain price, like not going to fall below a certain price, so we can just sell puts and collect the premium as an additional income. And then the third reason is they do stock replacement while waiting for confirmation of exercise, right? And what this is think of you wanting to buy Apple, right? But you don't know, you're waiting for earnings to come out and you don't know if Apple's earnings are going to be good or bad and how it's going to affect the stock price. So what they usually will do is they will buy a 0.85 delta 6 months or longer. All right, so that means a very much in the money option that has 6 months till expiration, right? And so let's look at it like this: 100 Apple shares cost right now at today's price, it's 177.5. So that would be $17,750 to own 100 Apple shares, right? Well, with a 0.85 delta option, 6 months from now, like it moves dollar to dollar, almost dollar to dollar with the stock price. So one option shares of Apple with a 0.85 delta 6 months from now would be the 15 July 135 call. And that's going to cost you $4,635, right? And that's with $4,250 worth of intrinsic value. So if it expires, like, and you decide not to exercise, you at least have $4,250 worth of intrinsic value that you will keep. So everybody's scared to play options because they think of the extrinsic value, but extrinsic value is out of the money options, and extrinsic value is only time based, which is why people lose a lot of money in options. Institutions don't really play out the money options with just pure extrinsic value because they're smart. But anyway, we're going to talk all about these in individual videos, and I hope you enjoy it.